Is gold investing on the cusp of a new era? What's new? The lack of rate cuts haven't been a problem for gold, and without any clear indication of when rate cuts will come, gold continues to demonstrate impressive price durability. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe, and we'll keep you in the know. Interest rates have been stuck at 23-year highs since last July. Still, in the midst of this oppressive rate climate, gold has managed to shine, climbing 14% over the previous 7 weeks to more than $2,300 per ounce. So could it be that the recent resilience we've seen from gold has less to do with interest rates and more with the possibility that a paradigm shift in gold investing may be unfolding in real time? The Financial Times suggests it may be possible. In a recent article, the Times implies that when it comes to gold's abrupt moves, there are deeper, longer-term messages in this rise that investors should pay very close attention to. In a nutshell, the current gold environment may not be a result of anticipated rate cuts, but rather of widespread changes in key dynamics of the global economy. Changes that include steady inflation, a slow shift away from the dollar, persistent geopolitical tension, and declining fiscal stability. On inflation specifically, the Financial Times notes, "It's hard to think of a macro trend at that moment that isn't inflationary. The economy is running hot, from fiscal stimulus in the U.S. to more supply chain redundancy as countries de-risk, to all the capital investment required for the clean energy transition and re-industrialization in rich countries." The Times cites heightened geopolitical tension and de-dollarization as structural gold drivers as well. Trade tensions between the West and China are growing. Meanwhile, the weaponization of the dollar following the outbreak of war in Ukraine has quickened moves in many countries, most importantly China, to sell treasury bills and buy gold as a hedge against America's financial might. In a recent economic update, I mentioned that the national debt has been rising at an unbelievable rate of $1 trillion approximately every 100 days. I also discussed the opinion of Michael Hartnett, Chief Investment Strategist at Bank of America, that this disturbing trend is one reason for gold's recent move higher. Along the same line, the Financial Times sees potential positive implications for gold arising from the nation's declining fiscal profile. This is exciting for gold, but not so much for our country. We have to be honest with ourselves. Do we see government spending changing anytime soon? The most recent Congressional Budget Office projections put U.S. debt at 99% of GDP by the end of this year, and have it on track to reach 172% by 2054. If this happens, the result would be monetization inflation, financial repression, and a period of extreme chaos in monetary policy and markets. Bad for the world, good for gold. And while experts can only project, not promise, there's been several optimistic price forecasts for gold these days. This includes an exceptional forecast of $4,000 per ounce gold in the not-too-distant future. But what makes their projection so compelling is not the actual price target, which of course may or may not be actually reached, but the basis for it. This isn't just an interest rate thing. People are hedging against a new world. With the foundational economic and geopolitical dynamics in play currently, investors may believe, just like the Financial Times does, that many of gold and silver's current drivers transcend central bank rate policy. When you examine these trends, ask yourself, where do you believe the world, our country, and the dollar are heading? And you may conclude that a new era of gold investing is upon us. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.